Hi, everyone, and welcome to this week's edition of What's Driving Token Prices. I'm your host, Katie Talati, Director of Research at Arca. For those joining us for the first time, I'm responsible for identifying and analyzing digital asset and blockchain opportunities for Arca's funds. As part of our research, my team and I examine token prices and the market events that act as catalysts for price change. Based on our research and market events over the past week, here's some notable token price moves and what we think drove these moves. As a reminder, this commentary is not intended to be investment advice, investment research, or an investment recommendation. Please consult your investment professional for your own circumstances. Hi, everyone. Welcome back to an exciting week. Just in the last couple of days, we've had the Genius Stablecoin Act pass in the House and Senate, which is a huge landmark piece, especially moving crypto and stablecoin payments forward, hopefully in a more positive and, regulated light. The other big thing that has happened is obviously Bitcoin is once again pushing all-time highs. The market seems to be very frothy for Bitcoin, but as always, we're here to talk about tokens outside of mostly Bitcoin. And so we will get in here today. Okay, so first I'm actually going to talk about Fluid. So if you're not familiar with Fluid, it is a DeFi protocol. They basically have a DEX and a lend borrow protocol. And they have actually faced some criticism in the last week because some of the data has been showing that on their decentralized protocol, their decentralized exchange, that they've actually lost liquidity providers $8.5 million since the launch last December. So let's just roll back for a minute. What are liquidity providers? What does that mean? So in decentralized exchanges, the very common structure to have without basically for non-order book exchanges is called something called an automated market maker, an AMM design. Now, an AMM design essentially relies on people putting money into a pool, usually two-sided pool, and usually you contribute, one or the other asset or both assets. And by contributing to the pool, you share in the trading fees from it. And so you're essentially acting as an individual market maker, but in these pools. Now, the problem, though, with generally in AMM designs in general, and I'm very much generalizing this so I can simplify down the problems that Fluid is having this past week or 10 days, is that AMMs suffer something called impermanent loss, or IL. Now, impermanent loss is the idea that if you are putting two non-stable assets into a pool, what can happen is that if there's volatility one way or another, you end up losing money if the pool becomes unbalanced and you end up with, say, more of the asset that has gone down in price versus the asset that's gone up in price or stayed the same. So impermanent loss is like a very big problem that DEXs have. Uniswap has had it over the years. They've solved for it in a lot of their iterations. Now there's like more sophisticated mechanisms to kind of balance these pools out. The big issue, though, is that Fluid kind of advertised themselves as not having impermanent loss as a big issue on their DEX because there were supposedly going to be fees that made up for fees on the DEX would make up for liquidity providers losing that impermanent loss elsewhere. So this past week on Twitter, somebody highlighted that Fluid liquidity providers have lost $8.5 million to impermanent loss since the launch of their major pool, their biggest, most liquid pool, which is their ETH USDC pool. So most people would think, oh yeah, an Ethereum pool would be a very liquid trading venue, especially because you can arbit on exchanges. Everyone owns ETH, everyone owns USDC. So it was a bit of a shock to see, I guess, that like this pool had lost so much money. People really were woken up to like, wow, like their design was supposed to be better than this. So the problem really, though, is that Fluid basically designed their pool to rebalance if there was a plus or minus 10% change. But ETH, if you have been watching it at all, has just had such wide price swings in the last 6 months. It's literally gone from like 3K down to like 15K up now to, I think we're at 27K. And so up and down with all these swings, basically LPs have lost money in every direction as a result. Basically, it's like I said, it's really hurt the LPs in the pool. The Fluid team did state in a public forum post about 10 days ago that their V2 design, which is expected in the next couple months, should fix a lot of these issues. Critics do counter that these design changes may only complicate the protocol further for inexperienced traders. So nothing is solved yet. In the meantime, the protocol is planning to compensate users affected with Fluid tokens and more monthly Fluid rewards until a permanent fix is found. But I got to say, the Fluid token has really taken it on the chin since this initial forum post and these issues were pointed out, and it is down 19% for the week. Okay, next we're going to talk about Bonk. So Bonk, as we've talked about, I think in the past, is a very popular meme coin on Solana. They actually released a token launch pad in late April called Bonk.fun. I think I did mention it. That's broken out quite a bit in popularity over the last 10 days. But what's been more interesting is that in the last week, Bonk actually announced how that's going to tie in more closely with their tokenomics. So it's actually, despite this, despite its kind of meme background, Bonk is on pace to be one of the highest revenue producing tokens / products in crypto. So Bonk announced that they're going to be buying back their Bonk token with 35% of the fees generated on Bonk.fun. Since the platform's averaging about 381,000 per day in fees, that's going to equate to 139 million in annual fees and $48 million in buybacks over the year. In addition to this, though, Bonk also has a trading Telegram tool or Telegram bot, which has produced $140 million in the last year in fees. Bonk does buy back the Bonk token with 100% of the fees generated from the Bonk bot. So we're looking at almost $200 million in potential buy pressure on Bonk, which could potentially be pretty good. The market, though, doesn't seem to react to this type of news or these fundamental changes. Bonk is down 12% for the week. All right, next we're going to talk about something cool. So last week, a proposal went live for the decentralized derivative exchange Synthetix to acquire Derive, which is a decentralized options protocol. And they're going to be doing this M&A via a token swap. So for those who aren't familiar, Synthetix has been around for a very long time. They are one of the larger decentralized derivatives protocol. And Derive, which was previously called Lyra, was launched as a decentralized options protocol. They've gone through a few iterations, obviously renamed themselves. So the proposal was on the Derive forum technically. And again, it is just in the proposal phase. But the deal would be done via a token swap where Synthetix would trade token. It would basically swap some of its tokens for Derive and absorb the team and the product completely. So the deal would value Derive at about $27 million, which is kind of around, it's a little less than where the token trades in the public market. However, Synthetix is planning to mint 29.3 million new SNX tokens in order to make the acquisition happen. Critics have said, this move, this is ridiculous because Derive actually has assets in its treasury, not a ton, a couple $1 million though of ETH, Optimism, and some stable coins. And Synthetix is essentially printing the money out of thin air to purchase these. So according to Kane Warwick, who is Synthetix founder, the acquisition does strengthen Synthetix product execution roadmap, which Derive has been super successful in. And so we'll see. So if the deal goes through, SNX tokens received through the acquisition would be locked up for 3 months and vest over 9 months. And for the acquisition to go through, an official proposal and vote would need to happen within both DAOs for Synthetix and Derive, neither of which is live yet. So very much early days. This could be super beneficial. Obviously, this is a space that is ripe for M&A, as we've seen in the past. And so we will see. Derive is down 7.5% this past week, and Synthetix is down 10%. All right, last but not least, we're going to talk about Solana, which, if you have not heard, is having a conference this week in New York. So expect more exciting announcements out of them. But the first one happened on Monday when Chainlink announced that they've launched their cross-chain interoperability protocol on Solana's layer 1, which is going to not just allow developers to access Chainlink's Oracle data feeds, but they can also use the CCIP standard for cross-chain messaging. So if you're wondering, what does all this mean? The basic idea is that because Solana has a very unique code base, coding language, and smart contract language, and the smart contract virtual machine that is basically what executes the smart contracts, as a result of that, it is actually really hard for anything built on Ethereum or built for Ethereum, kind of more or Ethereum virtual machine based chains to then come over and use Solana. So usually what it requires is kind of like a coding from the ground up. Now, the big thing in the last few years is that everyone's asking, with all these chains, with all these layer 2s, how are we going to have kind of commerce flow easily between them? There are a lot of solutions out there. There's Chainlink's CCIP as a messaging protocol. So it's not value transfer, but it's the idea that you can send messages back and forth without kind of having to go through intermediaries. And then the other solution is Layer 0, also has a messaging protocol. So big news that they've basically opened up Solana in this way. It really does allow kind of more assets to flow to and from the Solana ecosystem, which is going to be really important as Solana continues to grow. Well, that's all I got for you guys this week. I hope you enjoyed our insights. Tune in here again next Wednesday at 1 p.m. Pacific to hear what's driving token prices.